The stock market's been going down substantially over the last 30 days. This past week was a doozy. The NASDAQ went down significantly. And officially, the NASDAQ is now down more than 10%, which is officially in correction territory. So stocks are great to invest in. Over the long term, they provide a great return. But stocks can also show short-term losses. Not too long ago in 2022, the S&P went down close to 26% in 1 year. So if you're an investor and let's say you had your life savings in stocks and you needed the money and you were going through 2022, I imagine that year was really uncomfortable. So what do investors do? Do you just invest in stocks and let it ride? Or do you diversify and go into bonds where bonds are far more stable? Better yet, when stocks fall, bonds rise. They go up in value. They also have a more consistent income stream. So today, I want to talk about bonds just to kind of brush over some things that are important to consider as you manage your portfolio. Now, portfolios should be created for the investor's preferences, needs, timelines that investor needs. For example, if you're a young investor and heck, you don't really need this money, you might need it in case of emergency. Um, I would encourage you to really be mostly into stocks. Take the biggest risks when you're young, buy great companies that are growing, keep that money invested for the next 20, 30 years. That should go great. Bonds should be a small portion of your investing mix. As you get older, as I have, you can't get around it. You keep breathing in and out and waking up every day. You wake up and you're 55 years old. I am looking at, potentially retiring at some point in the future. And I'd like to know, my next 5 years, how can I cover my expenses? I don't care if the stock market's doing well, if the stock market's doing great, if the stock market's doing poorly. Doesn't matter. Next 5 years, I want that completely checked off. I have what I need for the next 5 years. And that's what I want to talk about today is really just balancing portfolios with some bonds and showing that bonds for the past week, especially, have done really well. They've performed great. Bonds went up in value last week significantly, and they really preserved an income stream to those bondholders who bought in advance and bought long term. Bondholders are looking good at this moment as stock prices continue to fall. Just a few basics. When we look at portfolios, and this is high level, when we look at a portfolio, you can consider a portfolio aggressive growth if you invest primarily into stocks. I completely agree with that. And depending on where you reside, like I'm in the US, domestic stocks, as well as some foreign stocks. This aggressive portfolio is 85% stocks, 15% bonds. So that's an aggressive growth fund. You have growth, which would be 50% or so in domestic stocks, 21% in foreign stocks, and about 25% in bonds, and then 5% cash. Balanced, about 50% in stocks, both domestic and foreign, 40% bonds, and then 10% in cash. And then very conservative, this investor would have 50% in bonds, 30% short-term investments, 14% stocks, and then 6% in foreign stocks. So that's really conservative. But frankly, let's say somebody's 75 years old and you know what? They just don't really want to fuss with the stock market anymore. I could totally understand that. So I'm 55, but I'm primarily into stocks. I have invested into bonds. I saw the opportunity approaching a few years ago, and I started buying into bonds, kind of setting up a really nice bond ladder that I'll show later. And I'm really glad I did so just to counter that risk. 2022 was, uncomfortable for me. I saw, my great stocks like Meta as an example just tanked. It went down more than 80%. Can you imagine that? Meta. And it really reminded me that, hey, even though you own great companies, the market may just decide, hey, we're going to sell them off. We're going to devalue the value of those stocks. So diversify. So that's what I'm going to cover today. Let's continue on talking about bonds. So another way to look at bonds versus stocks is, the average return. This graph here is pretty good. And it kind of shows you a very long timeline, 94 years, right? Nobody's going to invest for 94 years. I guess you'd have to be born and start picking stocks. There's just no way you can invest for 94 years. But it kind of proves the point that over the long haul, what are the returns for bonds and stocks? And if a person using one extreme just invested in bonds for 94 years, that's represented by the very top item on this chart, and the person would do an average return of 5.3%. And if they just went stocks for that term, they would do a 10.3% return, almost a doubling of return. We all know that. We all know that. So stocks are the place to be for long-term appreciation. But stocks, we know, have more volatility than bonds, and they can have painful years like 2022 or after the dot-com bubble or after the subprime mortgage meltdown in 2007. The years after those events were really painful. Or COVID in 2020. If you saw your portfolio of stocks, just have a crashing effect, and you lost a significant amount of your investments in the course of 1 month, that gets pretty darn scary. So it's not a matter of, hey, I just want to go stocks and I'll just deal with the ramifications. Maybe, hey, you're an investor like that, more power to you. I'm more, kind of probably around this range of the 70 to 80% range toward stocks. Bonds primarily pay an interest rate, and bonds are easier to understand than stocks. You buy a bond, let's just keep it simple as an example. You buy a 10-year treasury. You're going to own that bond for 10 years. Each year, the US government's going to pay you an interest rate. Right now, the 10-year yield, if you were to buy it at this moment, the government would pay you 3.791%. That's the interest rate on that bond. So that's pretty simple. Stocks, on the other hand, is the stock going to go up in value, down in value? Are the earnings calls going to affect the stock price? There's a lot of moving pieces to a stock. Bonds, on the other hand, in my opinion, are quite simple. It's a term. In this case, it's 10 years. And who is issuing out the bond? Another way of thinking of bonds is debt. When somebody issues a bond, they're actually saying, hey, this is an IOU. This is a debt instrument. You're lending me money, and I'm giving you this bond. So the US government is issuing this bond for 3.791% interest rate. That's great. Now, one thing to point out, shortly after COVID, the Federal Reserve, who's been in the news this past week, they really lowered interest rates. And frankly, interest rates fall when economic times are bad. Needless to say, when we hit the COVID years, the economy was in terrible condition. And the reason for that is that the economy kind of froze, especially for some industries. Consider the airlines. They couldn't fly passengers around because everybody had to be masked up and couldn't go anywhere. So interest rates just collapsed. They were near zero. So was I invested in bonds? Absolutely not. Why would I invest in an investment that assured me to pay me close to zero? No, thank you. I'm giving up the freedom to use that capital as I see fit for no rate of return. No, thank you. And then as rates go up, the value of a bond goes down. And the reason for that is when you buy a bond, you buy it with a specified coupon rate. The coupon rate on this 10-year treasury, if you were to buy it today, is 3.791%. As interest rates move, the value of a bond you buy will also move. As interest rates climb, that bond will decrease in value because you have to balance the market rate of return with the coupon rate of return in a bond. If the interest rates rise, bond values fall. If interest rates fall, bond values go up. So let's play this out a little bit. If you recall, Silicon Valley Bank went bankrupt. And they went bankrupt because interest rates began to rise very fast. This was like kind of really neck breaking for interest rates to rise so much. They went from, at the beginning of 2022, 1.5 approximately, and they pretty much more than doubled in the course, and actually they more than tripled over the course of a year, which is incredibly fast. And what it caused is Silicon Valley Bank had bonds, long-term bonds. So as interest rates rise, bond values drop. So then Silicon Valley Bank said, oh, our bonds are worth less. So they had to restate them. When they went public with that information that, hey, we have to restate our bond assets on our balance sheet and take losses, there was a run on that bank. It wasn't a cash event, but it showed that, hey, interest rate moves will cause a change in bond values. So Silicon Valley Bank went bankrupt. And other banks really their stock prices went down significantly because they hold long-term bonds. But as we play this out and look at the current year, we're seeing that within the last year, we've gone from 5% down to 3.8. So that's a significant drop. So now bondholders are sitting pretty. Their bond values are going up and they're being paid really a 5% return when every other investor today that buys the same equivalent bond with the same risk is only going to be paid 3.8%. And that's why buying bonds, maybe with a long-term horizon of 5 to 10 years, might be a good idea. I'm glad I put some time into looking at bonds years ago because I knew that higher interest rates were going to make bonds more attractive. And I've set up a bond ladder for myself, and I'd like to show that to you. So I've set up bonds with maturity dates over the course of the next 5 years and even further, really over the course of the next 10, 15 years, but predominantly over the next 5 years. I've set it up in what is called a bond ladder. And each rung of that ladder takes care of maturity cash flow coming when that bond, that loan, the person who issued out the loan says, all right, thanks for buying my bond. I'm returning the face value of this bond to you. In the case of Citigroup on Monday, they are going to return my capital, and which is $4,000, and they're going to pay me an interest, and I'm going to have a gain on it as well because I bought it less than $4,000. And over the course of time, let's say in 2025, I have all these companies or institutions like the US government that issued out debt that I bought those bonds, and they will pay me collectively $102,000. I'll earn an interest rate. I'll have an appreciation on that as well. So combined, that's going to be a nice return of roughly, call it 8 to 9% on bonds. That's very good considering that the stock market's really crashing these days. So that looks good. Now, I can go down and kind of show you year by year, but really what I'm trying to do here is fit this portfolio of bonds around my desire to have the next 5 years taken care of. I have cash flow coming in. The stock market can continue to crash. Doesn't affect the next 5 years of my living expenses. That's off the table. And then I can take investments or take risks that I'm willing to take with stocks and real estate and so forth because I have my bond ladder, and I'll continue to add money into the bond ladder so the next 5 years are taken care of. One stock that I want, or investment that I wanted to highlight to show you that bonds, if bought at the right time, can really perform, is this bond issued out by Petróleos Mexicanos. This is the oil company down in Mexico. They have a bond that they issued out, and I bought it for roughly $39,000. Call it $40,000. Over the course of this bond period, or the time that I own this bond, it's going to appreciate by 25%. Then they're going to give me $50,000 at the in 2030. In the meantime, they're going to pay me 6.84%. The yield, if I look at it year to year, this thing's yielding about 12%. And that's phenomenal. When you look at, I bought a bond in Mexico I'm familiar with because it's just south of the United States. It's in the oil complex, which we're not going to we're not going to stop using oil in the next 10 years. So a lot of things I like about that investment, specifically that it has about a 12% return. Year after year, I'll make 12% on this bond. So that's an opportunity for me to have not just a kind of boring, hey, I'm going to make 3% on bonds. There's also corporate bonds and international corporate bonds that could really perform well. So wanted to highlight that. This past week has been really tough on stocks, but it's actually been a parade for bonds. My bonds in just 2 days of trading went up close to 1%. So I have my portfolio of bonds, and this is just my partial portfolio. I have about another 100,000 in bonds. It went up $3,600 in value. And that's pretty good considering that my stocks went down significantly, well more than $3,600. But that's evidence that this is a hedge on the stock market. When the stock market is failing, bonds really stand up tall, and the performance is quite acceptable considering that, other stocks, let's say my Intel stock that crashed and burned in one day, like 26, 27%. Boy, I'm glad that I own bonds in this period of time. And for the year to date, if you consider, the rate of return year to date on my bonds is 4.26%. That's pretty good considering the S&P is at 12%, but it's trending down. We may end with maybe the S&P being at 6, maybe 8% return. When you consider the amount of risk we have to take when we go into stocks, this rate of return is looking pretty good because by the end of the year, I'm probably going to do 7, 8% on bonds. That's excellent because the risk on bonds is far lower than stocks. They're not going to keep me up at night. They're not going to be swinging down, especially in value. So this isn't the first bond video that I've created. If you've watched my channel for a while, I've been creating bond videos for a couple years. And really, the reason for it is one, I want to continue to learn, and learning bonds is important because as I get older, bonds are going to be really, really important to just have my living expenses covered and have a really stable income. I'll have fun with stocks. I'll have fun investing in real estate, which real estate's getting a little better, by the way, from an investing profile. But let me stick to bonds for the moment. So I encourage you to learn more about bonds. If you're young, bonds aren't that important to you now, but they eventually will be. Or maybe if you're young and you want to save up to buy a house, well, you may not want to put all that money that you're saving toward a house in stocks, because what if a couple of your stocks, like Intel in my example, crash and burn? Well, man, it's going to take a longer period of time for you to be able to put that down payment on a house. Or you have a child that's about to go to college, maybe in 4 or 5 years. Obviously, you want to make sure the money that you have saved up is ready to go when you have to start paying for tuition for that son or daughter. There's a lot of life events that you need to consider, and that's where bonds begin to really play a role. A good portfolio is really putting bonds in the right place to serve the purpose for that outcome that you're looking for. Every portfolio should fit the investor, specifically what that investor wants out of that portfolio. We work hard for our money. We invest so our money makes more appreciation and creates more value for ourselves and the people we care about, so that we can buy the things we want to enjoy, take care of the people we love, have the experiences we want to have, like traveling or being able to, take some time off. All those things are important. So that's my video on bonds. I hope you found it interesting, and I really encourage you to learn more about bonds. They're a little bit boring, but I think it's worth investing your time to become more familiar with bonds. I really appreciate you watching, and good luck investing in 2024.